Welcome back to this very special Newsmaker segment where we have been speaking with the Chairman and Managing Director of Larsen Toubro, Mr. S.N. Subrahmanyan. SNS, thank you for your patience. Let me come to where perhaps you have much more control. Nabha, you've already said that you are going to divest. We hear people are interested. Should we get a fructifying of the divestment?
It's a good question on your part. Now, listen, Nabha is, why did we get into Nabha? It is a power plant where we sell power to the Punjab government. It's a very critical asset there because that supplies nearly most of the needs of the Punjab government because most of the other plants are not up to the mark. So having said that, we went into Nabha because when we got into EPC power, the boiler, making the boiler, the turbine, the pulverizers, the EPC part, etc. We wanted to prove ourselves that we can not only make these equipments, we can supply it, we can put it all together and make it work. So Nabha was a way to do it because outside world was not coming out with such kind of EPC orders. So we did Nabha. It's a 2 into 700 megawatt plant, probably the best run power plant in the country with the highest operational efficiency and plant load factor, right? The fact is today, we built it at a particular cost, right? And today it's about 5 odd crore per megawatt. Today, power plants in the market are available for 2.9, 3.1. Okay, I don't know the state of these power plants. Maybe somebody should buy it and clean it up and spend some money in refurbishing it, etc., to get it back into stream. I'm not sure there is anybody in the market to pay me that 5.5 crore per megawatt. If somebody is willing to pay that, we'll definitely look at it.
So it may take a while, you're saying?
It may take a while. But there is an agreement there, and we also have to look at the timelines. But it's a fantastic plant, operating very well. I probably review it once in 6 months. There's another colleague of mine.
But it's not making losses for you?
No, it gives me 450 crores a year a pat. So, and it's a cash-rich plant. Everything is positive there, except the cost of the plant.
Okay. Fair enough. Let me come to the other one where you reported the losses. They are declining in Hyderabad Metro. Yeah. But it is, there also you have a lot of land to monetize. So can you tell us whether it will become profitable soon because of the monetization of the land? What's the...
It's probably the most complicated investment that we ever done. We have put more than 20,000 crores there and probably running one of the few private metros on earth. Probably we should not have done it, but we have done it. And now it's an asset with us. It's again probably one of the best run metros in the world. We do compare ourselves with Hong Kong, Singapore and such. It carries about 450,000 passengers per day today. It has a revenue of about 750, 800 crores. And it makes a loss of about 600, 700 crores, primarily because of the borrowings. We have 13,000 odd crores of borrowings, and at an interest rate of 7.5%, that's a loss on the books. But there's a depreciation, so it lessens the cash flow burden, but it's a loss on the books. We have monetizable land. Some of it we have monetized. Some of it is yet to be monetized. We are in the process of doing it. So the whole attempt there, Lata, is to, by monetizing land and by recent, with the help of the state government, we did increase the fares a bit by about 20%. The losses have come down. In my opinion, we need a couple of more fare increases and a little help from Hyderabad people to travel more on the metros. The COVID took away a lot of people. Now they're coming back to offices, schools, etc. So if the traffic goes to about 600,000 from about 450, 475 today, and with a slight increase in fare and land monetization, it could be made profitable. It will never give us a return on investment, but let's see how to take it forward.
You can cut the losses. Okay, okay. And the semiconductors, what is the plan and when will it start giving you money?
So it's an idea that came about. Now you'll find me strange talking about it because I'm labeled as an infrastructure man, but I learned to talk a little bit about IT, technology services and semiconductors now. So this, the idea was given by one of my colleagues. And the idea was to look at the entire ecosystem. When India was opening up and the government at the highest level was looking at electronics, semiconductor from self-reliance and other points of view, which is essential and rightly so, we did take a serious look at it. After a lot of debate and thought process inside, we decided that we don't have the pockets to put up a fab or an OSAT facility because there's a lot of investment.
So it was designing.
Yeah. So we have to be reasonable to what we are as an organization. So I said we'll go for Fabless, which is a design company. So an ex-friend of ours from Texas Instruments, he was the chief engineering manager. He has come in as the chief executive. We already have about 400 odd people working there. There's a front office in Austin, Munich and Tokyo. Main front office is Austin. We have a base in Bangalore, about 350 odd people are working in Bangalore. We recruited some very, very high-end and very capable people from many semiconductor companies to work there. Very early days. We have about 7 agreements today to make a fab design, chip design. Let's see how it moves forward as you go forward. I have a reasonable feeling in my mind that this should do well, and we will go behind it to see how to make it succeed.
Okay. So again, to come back to the investing public which is listening to you, you will have your real estate really give you. It's a better margin industry, and you're getting into other kinds of manufacturing like electrolyzers. Given all this, do you think in the next 5-year period, you will be able to break out of your core margin range? You're around that 8.5 range. Can it, because of the nature of the jobs you're undertaking now, will it increase beyond this to double digit?
We're a consolidated balance sheet, right? So ultimately, it's a weighted average profitability. So in my opinion, if the services come to 25% and services start contributing more than 50% of the net profit of the company, undoubtedly the weighted average profit of the company will slightly improve.
So it will come mainly from services, you're saying?
Huh?
The improvement will come mainly from services, not from...
That's the way it goes. See, in an EPC business...
And you're including real estate there?
Yeah. I classify real estate as services because it's probably one of the few B2C businesses that we'll have. L&T Finance is a B2C business. LTIMindtree and LTTS are B2B businesses, but they're a services business, and that should do well. So the way I look at it, EPC, when you look at it, there's always a project which gives reasonable margin. But there's always a project which also does not do well. So on a good day, on a net profit basis, we maybe find out 6%, then we open the champagne. But most of the days it is at 4 to 5, so we get to drink water. So that's the way the business is structured. I wish in my lifetime it would change, but now 41 years, I don't see it changing too much.
That's why I was concentrating on the non-construction activities that you're undertaking. Well, just the final question, again, from my stock market audience. Do you focus on core margins or ROE as a management person, as the person heading the ship? And what guidance can you give us in terms of ROE? You had a very good one. The last quarter is 17%. Can you give us a headline with a new number?
The internal reviews are focused on profitability. There's no point in talking to a business head or a SBG head on return on equity. He's not involved in that. He is interested in ensuring that there's we call it PBC, progress, bill and collect. And that has to give the necessary margin for us. The internal reviews are all focused on PBIT, some cases PAT. But when we talk at the management level, our executive committee level, at the board level, we focus on return on equity. We have from 12% we have pushed it to 17. I'm reasonably confident there was an internal target of getting to 18. We will do that. But what will it be in 31 is work in progress because, as I mentioned to you, we just started our strategic plan 26 to 31. We had some internal reviews, but we had to have a final review. We had to take it to the board, get it approved by them, and then we'll see where that leads us to. But it's a simple, modest, quiet company. We'll keep it to whatever we think we can achieve and take it forward in that particular manner.
I don't think anybody will agree it's a simple, modest company. It's one of India's largest builders, and I think it's a big headline for investors that you're reasonably confident the ROE goes higher from current levels. Thank you very much, SNS, for joining us on a whole range of topics that L&T covers.
Thank you very much. It's always a pleasure to be on CNBC, more so to be interviewed by you. And really appreciate your time, and thank you very, very much, not only to you, to your colleagues, and to all the audiences. Thank you very, very much.